Good afternoon, one and all present here. I am Priyanshu Srivastava standing in front of you along with my co-partners Anshu Dubey, Nandini Bansal and Naina Keswani to present a presentation on the topic Allowances and Perquisites under the head of salary. So, now let's move further with the first slide. So the first one is, what is this salary? Salary is a remuneration received by or occurring to an individual periodically for service rendered as a result of an express or implied contract. Now the question arises, what does the salary do? Under Section 17, Subclause 1 of the Income Tax Act gives an inclusive and an exhaustive definition of salaries. It says that salary includes wages, annuity, pension, gratuity, fees, commission, perquisites, profits, etc. So, now let's move further with the second slide, that is, what are perquisites? Perquisites are those facilities which are received by an employee from his employer in addition to his salary. There are three types of perquisites: taxable for all employees, taxable for specific employees, and tax-free perquisites. So now let's move further with the first one, that is taxable for all employees. These are divided into two types. First one is facility of rent-free house accommodation. It is divided into two cases. The first case is the case of government employees. Here, to calculate the value of taxable amount, first we will define the value of unfurnished house, which is already decided by the government. Then we will add value of furnishing in it, which can be either one of the two, either 10% of the value if house is owned by the employer, or it can be annual rent of furnishing material. By adding this, we will get the value of rent-free house. So after that, we will less the amount charged to employee's salary, so that we will get the value of concession in rent. Now, the second case is in case of private employees. In that, if the house is owned by employer, then there are three types from which we can calculate the value of unfurnished house. If the house is situated in the locality where population is exceeding 25 lakh, that means the town is big, then the value of unfurnished house will be 15% of salary. If the house is located in the area where the population is exceeding by 10 lakhs but less than 25 lakhs, then the value of unfurnished house will be 10% of the salary. But if the house is situated in the area where population is less than 10 lakhs, that is, the town is very small, so in that case the value of unfurnished house will be 7.5% of the salary. Now, in this value of unfurnished house, we will add the value of furnishing, which can be either one of the two, either 10% of the value if house is owned by the employer, or annual rent of furnishing material. Now we will get the value of rent-free house furnished, so that we will less the amount charged to employee's salary from it, and so that we will get the value of concession in rent. The next one is if the house is hired or taken on lease by the company. Now, in that case, the value of unfurnished house will be either 15% of salary or actual rent paid by the employer, whichever is less. And we will add the value of furnishing, which can be which is as usual 10% of the value if house is owned by the employer, or annual rent of furnishing material. Now, we will get the value of rent-free house furnished, so that we will less the amount charged to employee's salary from it, so that we will get the value of concession in rent.
Thank you, Priyansh, for your wonderful explanation. Now let's move further with valuation of motor car. Rule number 1: if the car is owned by the employer and the car is used by the employee completely and exclusively for the office duty, then the value of the car will be considered as nil and no tax will be charged. If the car is owned by the employer and used by the employee for his personal and private affair, then it will be charged under these heads: expenditure occurred on the car, remuneration paid to the driver, and depreciation 10% per annum, and also less by the amount charged to the employer salary. The third case is if the car is hired on lease by the employer. In this case, the valuation of the car will be considered under these heads. First, running and maintenance charges of the car, remuneration paid to the driver if any, and less by the amount charged to the employee's salary. The next rule is rule number second is if the car is owned and hired by the employer and used by the employee partly for the private purpose and partly for his office purpose, then this case will be considered under these two subcases. First one is if the entire expenses of the maintenance and the running of the motor car are borne by the employer. For the small car, 1500 will be provided per month to the employee, and for the large car 2500 will be provided to the employee per month. If the expenses of the maintenance and running for his car, personal and private purpose are borne by the employee himself, then for the small car 600 per month will be provided, and for the large car 900 per month will be provided. If there is also a driver provided, then 900 per month for his salary is also given. The next rule is if the employee has more than one car for private purpose. In this case, the first car will be calculated under the second rule first, and then other car will be calculated under the first rule second and third cases, according to the second and third cases. This facility is provided by the employer to the employee and rules. The tax will be only charged for the special employees. The rules for the special employees are: voting power is more than 20% of such substantial interest in general meeting, and the second rule is his monetary income must be more than 5000 per year before the deduction of under section 16.
Thank you, Nandini, for such a wonderful presentation. Now, this is Anshu Dubey to continue the presentation. Now, what are allowances? The allowances are the part of salary which is provided by an employer to his employee in cash in addition to the salary. The allowances are added to the salary of an individual and taxed under the head of income from salaries. Now, there are three types of allowances: fully taxable allowance, partly taxable allowance, and tax-free allowance. The fully taxable allowances are those allowances on which the assessee has to pay the tax over the full amount of the allowance. Now, the partly taxable allowances are those allowances over which the assessee has to pay the tax over some part of the allowances. Now, the tax-free allowances are those allowances over which the assessee has no need to pay the tax. Now, we further move on with the fully taxable allowances. The very first is dearness allowance. The dearness allowance is paid to the employee to compensate the rise in the price level. The dearness allowance is a fixed percentage of the person's basic salary that is added to the basic pay to calculate the gross salary. Now, the next one is overtime allowance. When an employee works for extra hours over and above his normal hours of duty, then he is provided by some extra wages, and that is known as overtime allowance. The next one is project allowance. It is the allowance paid by the employer to his employee who are engaged in a specific project to compensate for the expenses incurred due to the engagement in that particular project. Now, the next one is tiffin allowance. The tiffin allowance is the allowance which is provided by the employer to his employee to meet his food expenses. Sometimes these allowances are not provided to them only when the tiffin service is provided to the employee by the employer. The next one is rural allowance. The rural allowance is the allowance which is provided to the employer by the employee if he is sent to the rural area for some official work. Now, the next one is medical allowance. The medical allowance is a fixed allowance paid to the employees of a company on a monthly basis, irrespective of whether they submit the bills to substantiate the expenditure or not. The medical allowance is a permanent allowance which has no stoppage in its payment. Now, the next slide will be continued by Naina Keswani.
So now I am Naina Keswani. Now I will explain partly taxable allowance. In this type of allowance, entire amount will not be charged. Tax will be charged on some part of allowance. First one is house rent allowance, also known as HRA. In this type of allowance, the allowance which is paid to an employee from his employer forms a part of his salary. Second is entertainment allowance. This type of allowance is paid to an employee from his employer in cash with regular term for the hospitality purpose of customers. Next is children education allowance. The amount received on children education will be tax free from for up to rupees 100 per child per month, maximum up to 2 children. Next is children hostel allowance. The amount received on children hostel allowance will be tax free for up to 300 rupees per child per month, maximum up to 2 children. Next is traveling allowance. The allowance entire amount spent on this purpose will be tax free, and the remaining with the employer will be taxable. Next is border and remote area allowance. This allowance will be tax free from rupees 200 to 1300, depends on the area specificness. Next is tax free allowance. First one is allowances to government employees. When Indian servants go abroad for their assignments, they receive allowance to carry out their daily expenditure in another country. That is called allowances to government employees abroad. Next is allowances to employee of UNO. Allowances received by employee of UNO is also free from tax liability. Now third one is allowances to judge of High and Supreme Court. Allowances received by a judge of High Court and Supreme Court are also exempted from tax. Next is allowances to compensatory allowance. Compensatory allowance which is received by judges of High Court and Supreme Court are also exempted from tax as per Income Tax Act.